This presentation covers domestic and international dimensions of monetary policy. To see how Fed monetary policy actions have an impact on the economy by influencing market interest rates, we must understand how much money people desire to hold, the demand for money. All flows of non-barter transactions involve a stock of money. To use money, one must hold money. There are certain motivations that cause people to want to hold money balances. For instance, transactions demand, precautionary demand, and asset demand. Money balances are just synonymous with money, money stock, and money holdings. Transactions demand is the holding money as a medium of exchange to make payments, at a varying level related to nominal GDP. Precautionary demand results from holding money to meet unplanned expenditures and emergencies, and asset demand is just holding money as a store of value instead of holding other assets, such as certificates of deposit, corporate bonds, or stocks. So let's consider the demand for money curve. Assume that the amount of money demanded for transactions purposes is proportionate to income. Also, precautionary and asset demand are determined by the opportunity cost of holding money, that is the interest rate. Here we have the quantity of money demanded graphed against the price of money, or the interest rate. The Fed seeks to alter consumption, investment, and total aggregate expenditures by altering the rate of growth of the money supply. The Fed has four ways of doing this. It can use open market operations, changes in the reserve ratio, changes in the interest rate paid on reserves, and the discount rate changes. Open market operations refers to the Fed's purchasing and selling of government bonds that are issued by the U.S. Treasury. An open market operation causes a change in the price of these bonds. This graph shows that as the quantity of bonds increases, or the supply increases, then we move down the demand curve for bonds and we end up with a lower price. Conversely, if we reduce the supply of bonds, the price of bonds will increase. For example, suppose you paid $1,000 for a bond that pays $50 per year in interest. Then the bond yield is 5%. However, suppose you pay $500 for the same bond, still with 50% in interest, and instead your bond yield is 10%. The market price of existing bonds and all fixed income assets is inversely related to the rate of interest prevailing in the economy. What does this imply? A Fed open market sale that reduces the equilibrium price of bonds brings about an increase in the interest rate. A Fed open market purchase that boosts the equilibrium price of bonds generates a decrease in the interest rate. Now let's consider an increase in the money supply. What would happen if hundreds of millions of dollars in just printed bills was dropped from a helicopter? Well, obviously people would pick up the money and put it in their pockets. But how do they dispose of the new money? The direct effect of this would be that aggregate demand rises because with an increase in the money supply at any given price level, people now want to purchase more output of real goods and services. Indirectly, however, not everybody will necessarily spend the newfound money on goods and services. Some of the money gets deposited so banks have higher reserves and they lend out the excess. So now these banks lower their rates that they charge to induce borrowing. Businesses engage in investment, and individuals consume durable goods like housing and autos. The increased loans generate an increase in aggregate demand, so more people, even those who didn't get money from the helicopter, are involved in more spending. Quantitative easing was the Federal Reserve open market purchases intended to generate an increase in bank reserves at a nearly zero interest rate. Let's assume the economy is operating at less than full employment. Then an expansionary monetary policy can close the recessionary gap. The direct and indirect effects cause the aggregate demand curve to shift outward. Here we see that aggregate demand curve being shifted outward to meet the long-run aggregate supply curve such that our recessionary gap is covered. What about an inflationary gap? Contractionary monetary policy can eliminate this gap. Direct and indirect effects cause the aggregate demand curve to shift inward. Similarly, this shift inward brings us back to our long-run aggregate supply curve intersection, such that our inflationary gap is taken care of. So we've considered all of this within a closed economy, but when we move into an open economy, monetary policy becomes more complex. The net export effect of contractionary monetary policy. This suggests that such policy boosts the market interest rate. Higher rates attract foreign investment, the international price of the dollar rises, appreciation of the dollar reduces net exports, and there is a negative net export effect. The contractionary monetary policy will cause interest rates to rise. Such a rise will induce international inflows of funds, thereby raising the international value of the dollar and making U.S. goods less attractive abroad. The net export effect of contractionary monetary policy will be in the same direction as the monetary policy effect, thereby amplifying the effect of such policy. With expansionary monetary policy, the interest rates will fall, so financial capital flows out of the United States, demand for the dollar will decrease, the international price of the dollar will go down, and foreign goods look more expensive in the United States, so net exports increase, or imports fall. So what are the effects of globalization of international money markets? The Fed's ability to control the rate of growth of the money supply may be hampered as U.S. money markets become less isolated. If the Fed reduces the growth of the money supply, individuals and firms in the United States can obtain dollars from other sources and more regularly conduct transactions using other nations' currencies. Most media discussions of inflation focus on the short run, when the price index can fluctuate due to such events as oil price shocks or labor union strikes. However, in the long run, empirical studies show that excessive growth in the money supply results in inflation. Simple supply and demand arguments can be used to explain why the price level rises when the money supply increases. If the supply of money expands relative to the demand for money, people have more money balances than they desire, so their spending on goods and services increases, i.e. the price level rises. The equation of exchange is a formula indicating that the number of monetary units times the number of times each unit is spent on final goods and services is identical to the price level times real GDP. It shows the relationship between changes in the quantity of money in circulation and the price level. Here we see that equation. As we can see, money balances held by non-banking public times the income velocity of money is equivalent to the price level, or the price index, times real GDP per year. As previously stated, the income velocity of money is just the number of times per year a dollar is spent on final goods and services. It's equal to the nominal GDP divided by the money supply. The equation of exchange can be viewed as an identity. Since the total funds spent on final output equals total funds received, the value of goods, that is, the value of goods purchased, is equal to the value of goods sold. The quantity theory of money and prices suggests that changes in the money supply lead to equiproportional changes in the price level. If we assume that V and Y are constant, then our equation leads to the idea that an increase in the money supply, for instance by 20%, can lead to only a 20% increase in the price level. The Fed has sought to achieve an interest rate target. There is a fundamental tension between targeting the interest rate and controlling the money supply. The Fed can attempt to stabilize the interest rate or the money supply, but not both. This figure lays out the change we expect based off of interest rate money transmission mechanisms. We have a change in the monetary policy, which leads to a change in excess reserves, which ends up with a multiplicative change in the money supply, which leads to a change in the interest rate, which leads to a change in investment, which leads to a multiplicative change in real GDP. Let's look at this process graphically. As the money supply shifts outward, the interest rate pushes down. So, from our new interest rate, we shift from investment level here to an increased investment level. With this increased investment level, we know that aggregate demand shifts outward, which moves our long-run aggregate supply out to the intersection of short-run aggregate supply and the new aggregate demand, increasing our expected real GDP per year. The Fed can influence interest rates only by actively entering the market for federal government securities. The federal funds market is a private market in which banks can borrow reserves from other banks that want to lend them. Federal funds usually lent for overnight use. The federal funds rate is the interest rate that depository institutions pay to borrow reserves in the interbank federal funds market. The discount rate is the interest rate that the Federal Reserve charges for reserves that it lends to depository institutions through the discount window. It's sometimes referred to as the rediscount rate, or in Canada and England as the bank rate. In October 2008, Congress granted the Fed authority to pay interest on both required reserves and excess reserves of depository institutions. If the Fed raises the interest rate on reserves and thereby reduces the differential between the federal funds rate and the interest rate on reserves, banks have less incentive to lend reserves in the federal funds market. The FOMC directive is a document that summarizes the Federal Open Market Committee's general policy strategy. It establishes near-term objectives for the federal funds rate and specifies target ranges for money supply growth. The trading desk is an office at the Federal Reserve Bank of New York charged with implementing monetary policy strategies developed by the FOMC. The Taylor Rule is a suggested guideline for monetary policy. It looks to determine the Fed's interest rate target by looking at the estimated long-run real interest rate, deviation of the actual inflation rate from the Fed's objective, and the gap between actual real GDP and a measure of potential GDP. Credit policy is the Federal Reserve policy making involving direct lending to financial and non-financial firms. When many banking institutions were faced with possible bankruptcy in 2008, the Fed provided credit directly. This credit policy results in activities more closely resembling those of a private bank than a central bank. The Feds essentially paid banks a subsidy to keep hundreds of billions of dollars on deposit. These reserve deposits finance the Fed's credit policy of extending loans to banks, non-financial companies, and central banks. The three arguments in support of this credit policy are that it gives banks time to recover from the recent financial meltdown, it makes financial markets and institutions more liquid and solvent, and it contributes to international financial liquidity. However, critics of the credit policy have offered several arguments against it. They suggest it provides an incentive for institutions to operate less efficiently, that it reduces incentives to screen and monitor to limit asymmetric information problems, and it makes monetary policy less effective.